Thanks for joining. Welcome to today's webinar hosted by PwC and Akur8. Thanks a lot for joining us. My name is Anne-Laure. I'm COO of Akur8, the insurance pricing software designed for P&C carriers looking for automation and transparency. I'm honored to be introducing today's speakers. So with us for this webinar, we have Frederick Cripe, who's a senior advisor at PwC and was formerly a senior executive at Allstate. Fred has been involved in the US insurance industry for over 40 years. We have also Joseph Calandro Jr., who is a managing director at PwC's insurance advisory practice. Joe is an expert in enterprise risk management. He's also a published author and taught value investing and risk management courses in the MBA program at the University of Connecticut. And we have Boriana Trifonova, who is the head of sales in North America for Akur8. Boriana is leading the company's expansion in the US, fueled by the recent Series B fundraise. So what brings us all here today is the insurance industry beyond COVID-19, and more specifically, how to be successful as an insurer in the new normal. So COVID-19 has changed customer behaviors and their financial circumstances, and it has impacted virtually all business sectors. In today's webinar, Fred will start by expanding upon the impact on the insurance industry and discuss why being more nimble is a necessity in a rapidly changing environment. Next, Joe will deep dive into the impact of the government response on insurers' balance sheets and how AI and analytics will create an opportunity to adapt better to change. And finally, Boriana will focus on the implications for rate modeling and showcase how a robust pricing framework powered by technology can make insurers more nimble to change. So thanks a lot, and I will now let Fred kick it off.
Well, good afternoon, everyone. The COVID-19, the government's attempts to manage the disease, and then their attempts to manage the economic effects of their managing the COVID have really had impacts across the spectrum within the economy, how we live, how we shop, how we work. So just some short-term examples of short-term impacts: reduced personal auto use. We dropped about 15 to 20% of auto miles driven. Increased daytime home occupancy, which for those of you that insure homes meant reduced fires, reduced burglaries, increased business use of homes, which meant pressure on new coverages. Small business closures. We lost about a third of the small businesses in the US. A dramatic increase in pet ownership. So people adopted pets as they were at home. There have been dramatic changes in how companies, whether you're a retailer or a manufacturer, how they manage their inventory. If you had a weakness in your supply chain management, you now know what that weakness was. There's been further integration in the medical service industry. So in particular, pediatricians, I don't know of a single independent pediatrics practice that survived COVID-19. That will have cascading effects because one of the primary influences on the choice of OBGYN or internists is the recommendation from someone's pediatrician when they move out of that practice. If my math is correct, we in the US have had an additional $5.5 trillion worth of stimulus and more to come. That will cause inflation. The question isn't whether we'll have it, it's how much and how long. And then there's been reduced urbanization. A moving company, I'm not allowed to talk about who they are, that I've done a little work with, tracks where their destinations are. And unsurprisingly, the one-way trips that they've done for moving have have been heavily increased in the metro areas of New York and California during COVID-19. But interestingly, the places where people are going are no longer the urban areas of Texas, et cetera. Those areas that saw the greatest percentage increase were Idaho, the rural areas of North Carolina and Maine. So there's clearly been a movement towards moving back to rural areas. So the real question is, for all of these trends, is how long will they persist? What form are they going to take? Are they simply a step function up or down that will then return partway or totally to normal? So unfortunately, the trend towards increasing pet ownership appears to be one of those. Shelters all over the country are full as people who adopted pets during COVID are now going back to work and turning those pets back in, abandoning them. It may be acceleration or deceleration of a pre-existing trend. So I have no illusions that that increase in urbanization that's been occurring in the US, in fact, around the world for the last 25, 30 years is going to completely reverse and everyone's going to be moving back to the country. But I do believe that there will be a deceleration of that urbanization trend as a result of COVID. Maybe establishment of a new trend. So an easy example is prior to COVID, work from home was kind of idea that some people played with. You used it to retain really high quality employees who had moved where they couldn't commute to the office, but it wasn't sort of a standard part of your workforce management. It's now a regular part of human resources at most companies that can actually have employees work from home. It's also created a vulnerability to other shocks. One of the things about COVID-19 is, as an example, with all the money floating around out there, we're extraordinarily vulnerable to any supply chain disruption. If something happens to fuel prices, if something happens to, say, the ability of materials to come from China because of trouble in the Far East, all of those may actually trigger much more of an impact than the original COVID itself. And at its heart, the question becomes this: will these behaviors that people have taken on during COVID persist into the future? Is this the Great Depression, which for those of you that, knew people that actually went through the Great Depression as young adults, that affected their behaviors their entire life. My grandparents were young adults during the Great Depression. They were extraordinarily frugal, had an abhorrence of death. An easy example to sort of say that, demonstrate that. My grandparents used coffee percolators, old electric coffee percolators. They had a cord that detached so you could wash the percolator. And they used the same brand, same model of percolators. Certainly the entire time I knew them and was aware of it. When we moved and of course the percolators would wear out after a while, the heating elements would burn out in them. When we moved my grandfather in with my parents after my grandmother died, in their garage were 4 coffee cans filled with those cords from those electric percolators because there was no reason to throw away a perfectly good electrical cord in case you needed one again in the future. Now, they weren't hoarders, but they threw nothing away that they actually thought there might be use for in the future. Contrast that sort of behaviors that persisted into their 80s, 90s, and basically the rest of their lives with the Great Recession. The behaviors that people changed during the Great Recession, the 2008 through 2010, lasted about 5 years. And then everything returned to normal. And so that was not a persistent change in consumer behaviors. So 2020, we'll do a little deep dive on mileage driven, just to get an idea of how many things can influence the outcomes and how hard it is to predict the future. In 2020, we saw the largest drop in miles driven since World War II on a percentage basis. If you look back in history, there was a little dip in 1975. There was a little dip in 1979, both of those from spikes in gas prices. Then again, in 2007, there was a bit of a drop in gas prices that actually lasted several years because of the economic effects of the Great Recession and higher gas prices. But once again, that resumed its normal march upwards until 2020. when essentially people drove 400 billion fewer miles. So we went from 3.2 trillion miles to about 2.8 trillion miles driven. So the question becomes, how much of that will last? Will we go right back to where we were on the trend? Will some of that drop in mileage persist? It's one of the questions I get asked a lot. So best estimates right now of the permanent decrease in annual mileage as a result of COVID range up to about 74 billion miles annually. So it's about 3.5% of the total auto mileage. Just to put some perspective on this, there's about 42% of US jobs that can be done remotely. The rest, people actually have to be there. It's kind of hard to do a Zoom meeting for a heart surgery, kind of hard to build a car remotely. So there's a great many jobs that can't be done remotely, but 42% of them, by all estimates, can be. That varies significantly by geography, education, occupation. Obviously, that tends to be towards more corporate type office work. Accounting can be done remotely. Other jobs, healthcare, manufacturing, et cetera, can't. Now, the key though is that reduced congestion from people working at home impacts the expected losses of those drivers who aren't working at home. Any of you who are still commuting to work during the worst of COVID probably recognize that rush hour was a little more pleasant to drive in. Now, things that may change that, increased fuel costs could significantly amplify that decrease. So as gas prices continue to rise, will more and more people choose to stay home and work? That could easily make that 74 billion miles grow dramatically. Most of the estimates that I've seen and that I've been involved in forecast very minimal permanent reductions in shopping and social driving. So people are still going to drive to shop. They're still going to drive to go to visit family, to events, to school events, et cetera, to sporting. However, when they return to normal level is going to vary dramatically by geography. And there may be some increased comfort with online shopping that's going to continue on in the future. And so some of that driving for shopping purposes may in fact disappear as well. In the end, this is probably going to have more implications for your rating plans if you're doing private passenger auto than for your overall rate levels. It'll be a relatively small impact overall, even if it's more extreme than we're currently forecasting, but it will vary dramatically by geography. It'll vary dramatically by the education and occupation of drivers, both that you're insuring and who drive in the same areas of customers that you're insuring. All of that means, and every change from COVID really is going to have that same kind of, it may impact, the impact may persist, the impact may grow, the impact may shrink, and we don't really know exactly how it's going to play out. What that means is you're going to have to be nimble. You're going to have to really be in a position where you can shorten your cycle time from when an opportunity or problem arises in the marketplace until you have a solution in place that's working. So what does that mean? You can shorten at any step in that cycle. So the first possibility is to have robust strategies and tactics. And that's one of the processes that you can put in place that can be empowered by artificial intelligence. So what do I mean by robust strategies and tactics? That really means having rating plans, claim systems, tools in place that will work across a wide variety of possible futures. So if inflation takes off and it's 10%, well, we've got tactics in place that'll work fine there. Or if inflation is 5, it'll work fine if claim frequencies go up and driving returns to normal. It'll work fine if claim frequencies drop. Having strategies and tactics in place that work across a wide variety of possible futures means that when something changes, you as a company look at it and go, well, it changed, but we're still fine. The second phase in this is the insurer actually notices that there's a problem. In some cases, this can go on a long time before a company notices that there's a problem until they see it in their actual performance data. So ways you can shorten that cycle time, Do consumer research, actually not just surveys, but follow how your consumers behave online as they interact with you, as they interact with service or your claims operation. It involves competitor intelligence, not just sort of a periodically looking at what your key competitor has done in, one of the trade magazines, but actually having a robust system in place to track key competitors, what kinds of things they're doing in the marketplace, to put that information in a usable form in front of the key decision makers. Text mining. This is another opportunity for AI. And if you're not doing aggressive text mining out of your claim diaries, out of your underwriting data, out of the service interactions your customer service reps have with the customers, where you're actually turning that talk into text and mining it, you're missing a very significant opportunity to shorten the cycle time to identify problems. And then performance analytics, where you're actually looking at the insurance company data that you create. Some of that is standard performance data, so premiums, losses, exposures, sales, quotes, et cetera. But some of it is the time it takes for things to occur. So think about your claim process and the length of time it takes to complete each stage of settling a claim. That's new data that you've created, being able to analyze that in a way to see what does the speed of settling a claim have to do with, and each step in the way, with customer satisfaction, with ultimate severity. Then there's the issue of how long it takes the insurer to decide exactly how they're going to deal with this issue. That's really more about organizational design, putting the authority down as far in the organization as you can, and having preset action triggers where ahead of time you decide that if X occurs, then we're going to do Y, so that you've already built decisions in so that when results reach a certain level, action's automatically triggered. Then it's the time to develop the solution. One of the key opportunities here is using AI-empowered data and actuarial modeling tools. Whether you're designing a new rating plan and building your new rate relativities, whether you're looking at claims and claim service and doing claims analytics, all of those, there's an opportunity for AI to significantly enhance the speed with which you can do that while not compromising on, in some cases, improving the accuracy. Internal data sandboxes, where you can actually bring in small amounts of external data, play with them, and look at whether or not they're useful before you go to the trouble of actually acquiring large amounts of external data. Too many companies either make the decision to blindly acquire a lot of external data, taking time, or just go without. An external data sandbox really allows you to dramatically speed up the process of bringing in external data. The other piece in solution development is to have off-the-shelf customer and consumer behavior models that you've already pre-developed. Once again, AI can help with this. You know how customers are going to react to certain kinds of actions you might take, whether it's price increases, changes in your service, changes in the claim process. You already have models built that will let you know whether customers will be happier, less happy, whether they'll shop, whether they'll switch. All those models can be built ahead of time so that you can quickly deploy them and see what the effects of your actions are going to be. Implementing the solution, that's really down to standardized policy admin, billing, claims, and rating platforms. I'll be honest, I used to not be a fan of implementing out-of-the-box standardized platforms, whether it was Duck Creek or Guidewire. I've seen how much they can do about improving your cycle time in terms of changing products, in terms of changing claim practices. And it actually, this increased speed more than offsets any small amount of reduced flexibility that you have. Pilotless rollout schedules, where once again, if you've done all your research correctly and you're using a standard out-of-the-box admin system, you don't really need to do one state and see how it goes for 2 or 3 months before you start the rest of your rollout schedule. You can just run right into a rollout. And then the solution, or how you shorten the time until you know the solution is working, is really about moving to daily or weekly performance monitoring instead of weekly and monthly. Get on to the point where every day you know how many quotes, how many closures. You know how many customers defected today, where every week you know what your loss frequency looks like instead of waiting until the end of the month. Looking at a much shorter cycle time in terms of looking at data will also, in this case, improve your speed in understanding whether or not you've solved your problems. So 5 key takeaways. First, the magnitude and the timing of the effects of COVID still remain uncertain. I've done a lot of work with companies over the past year, helping them to try and understand what might happen in the future because of COVID. I can tell you that based on that work and based on other things that I've seen, anyone who tells you they know what the future is going to bring is kidding themselves or they're kidding you. The impact is going to vary significantly by segment, is a second key takeaway. Not every individual market segment is going to see the same impacts of what's happened with COVID. Non-COVID related impacts can create tipping points. This is the whole idea. The world is much more vulnerable to change now. A supply shock can dramatically change how inflation is going to play out. Changes in gas prices can dramatically change how people react to work from home and commuting mileage. Nimbleness is going to be critical to success. You're going to have to be faster and quicker in order to address problems as they come up. And then finally, inflation and interest rates remain a huge wild card because they're going to impact not only your losses, but both sides of the balance sheet, the loss reserves, as well as your assets. And so for a discussion of how inflation and interest rates might play out, I'm going to turn it over to Joe Calandro.
Joe, I don't think we hear you. Joe?
Can you hear me now?
Yes, all good.
Okay. Apologies for the technical issues. It's been that kind of day. Good afternoon, everyone. I want to kick things off with kind of a brief description of commercial insurers that are beginning to move from simple descriptive analytics to more cognitive analytics to exploit the power of artificial intelligence, enhance experience both internally and externally, and improve profitability across the cycle. Across the cycle is important, especially in commercial insurance, as we've just come off a historically hard market. Initial impressions are that the rate of price increases appears to be slowing, if not kind of capping off. And if that's true, we may be transitioning to more softer aspects of the cycle. And if that does happen, or when that happens, certainly insights from analytics kind of across the value chain are going to kind of increase in significance. Now, I know those of you in the corporate sector have seen many capability models like this in the past. There's a number of ways to interpret it. We tend to interpret it from a much more kind of conservative perspective. So for example, all commercial insurers have descriptive capabilities, like they're able to determine what happened. But very, very few are able to do that extremely quickly and directly from source systems to basic analytics without any human interference in the process. Same thing diagnostically. Every commercial insurer can determine and explain why things happen, but not all of them can do it quickly, and very few of them can do it automatically, again, from source system to analytics, and so up the chain. This is important, not only from a pure function perspective, but when you get into artificial intelligence, machine learning, and the like, the broader platform you have and the broader platform a machine is able to learn, the more insightful the analysis will be. And this is particularly important now, given some of the risks that Fred profiled and some of the risks that we're gonna speak to as well. As you may have gathered, right, there's kind of two aspects of this. There's the kind of automation aspect of it, where you're standardizing and simplifying your data environment to get it ready to be analyzed across a variety of functions. And then there's kind of the analytics path, and they both come together, as we just explained, in the artificial intelligence layer. I'm not going to spend too much time on this slide other than to say, keep in mind kind of the dual paths that this capability takes from both an automation analytics path. So we have two topics of discussion that we're going to talk to today. Financial lines cross accumulation and inflation. Both are financially related, as Fred kind of profiled, right? We live in historic times. Generally, we're getting some type of major financial crisis just about every 10 years, and this has happened for quite a long period of time now. Now, for any financial historian out there, you know that pattern is somewhat typical. We've seen these things throughout time. What is very, very atypical is the way global governments have responded to each crisis, seemingly increasing the amount of money printing or quantitative easing or new money pumping into the economy that kind of goes on. And as a result of that, we are right now a very leveraged economy, both domestically and globally. So before we get into the topics of cross accumulations and inflation, I want to kind of briefly talk about the subject of inflation, because we hear a lot about this. It's a popular topic on television, on the internet, and to Fred's point, there's a lot of talking heads saying, either that it's coming, that it's not coming, or knowing. So let's kind of look at the data and see what it tells us very, very briefly. I know this is a busy slide, but bear with me for a minute or two. So the top left-hand panel is basically just a profile of Federal Reserve balance sheet. And as you can see from the yellow highlighted cells, on a year-over-year basis, the Fed has been kind of very active, pumping money into the economy. And again, this is not just a one-year thing. We've seen this for quite a long period of time. The thing with monetary economics is that money, it doesn't move linearly, it moves in waves, right? So the financial sector is the first sector to get the new money, and then what they do with the new money, where they direct it, has kind of an influence on the pricing structure over time as the money makes its way through and new money kind of comes in. So when you say inflation, many economists talk about the consumer price index. It's a mathematical index. It may or may not have its uses, but for most normal people, we tend to, or other people, we tend to look at things like commodity prices and the like. And I've profiled those here on the upper right panel. And as you can see, we're showing some pretty big numbers, right, year over year of increases. So from a basic perspective, right, meaning monetary activity and commodity pricing activity, so we're seeing kind of the impact of that. But we're also seeing it in financial markets across the globe, including real estate. And this bottom panel here kind of profiles that, right? We're seeing kind of these big increases in real estate pricing. And again, this is a monetary phenomenon. So the question isn't, are we going to have inflation? And if so, like, when's it happening? Because it is happening. The problem really is, when's the inflation going to be a problem? And is there anything we can do about it to mitigate the potential risks of it? And in the interim, to kind of take advantage of some of the opportunities that are arising because of it. It's a double-edged sword, just like pretty much anything financial related. And that brings us to financial cross accumulations. So a brief definition. What is financial lines cross accumulation? It's the ability to assess and track potential financial impacts against both sides of an insurance balance sheet, assets and liabilities. And with respect to liabilities, it's kind of the credit-intensive lines, financial-intensive lines, such as directors and officers' liability, high-value workers' compensation, political risk, trade credit, surety, reinsurance recoverables, letters of credit, banking relationships, and the like. So as you can see, there's a very wide dimensionality in addition to just securities held on the left-hand side of the balance sheet. When we talk about accumulations analysis, most insurers default to prop cat, investments and recoverables tracking to some extent. And while the level of expertise varies widely across the industry, every insurer generally does these things. There's quite a few levels of manual intervention required to make it happen, but at least the capabilities are there. Beyond these lines, though, the capabilities are generally nascent. So, for example, some carriers do track D&O and high values workers' comp, but even the ones that do track it, it's generally not tracked as regular. It's heavily manual, and very, very few insurers right now are aggregating or cross-accumulating all that information to make decisions off of. There's some, but there's not many. Again, given the circumstances we're in now, we're starting to see much more activity in this space. And it involves not just internal data like we just talked about, but also the use of external third-party data, both conventional and unconventional. And in the financial space, the unconventional information has proven exceedingly important to those carriers who've paid attention to it. And even though not many have, there are some pretty telling examples, and I have a few of them I want to talk to you about. So the first goes back to the kind of the new economy boom bust, where firms like Enron, WorldCom, Tyco, and the like were booming. I can't specify which company I'm talking about now. I can't mention a firm name, but I knew an underwriter on one of their directors and office policies at the time. And this individual, like me, had an economics background, and he was very interested in behavioral economics. And he came across a study that profiled that one of the executives of a firm he was looking to renew rated very high with respect to behavioral risk for the way this individual talked to analysts or in the analyst community. So they had speech recognition software, again, a very early version of it. They did some keyword analysis, and this firm ranked inordinately high in that study, even though it was being touted in the business media as definitely the flavor of the day. So this led him to explore further, and he came across a short selling analysis of this firm by noted short seller Jim Chanos. And based on that, right, he decided he didn't want to renew, or if he was going to renew, it was going to be at a much lower capacity at a much higher rate. He wasn't allowed to do that. His manager overrode his decision. He had to kind of renew at expiring. Of course, during the new economy transition from boom to bust in the new economy, this firm failed, and as a result, D&O suits came in waves. Kind of the tragic part to this was the manager who overrode his decision basically blamed him for renewing it. He lost his job, left the insurance industry, went on to do exceptionally well in another industry, and the incompetent manager who overrode him and then let him go was promoted very high to a senior business unit executive position. Circumstances eventually caught up to that person and they were let go, but it was a decade or two before that happened, right? So that was tragic, but it kind of alerted me to both the power and the risks of unconventional information. And then we get to kind of 2007 and 2008. Many carriers were long real estate, did not really pay attention to what was going on into what Michael Lewis famously called the Big Short, even though it was out there and it was written about in many newsletters, more kind of on the value investing side of the house. One executive in particular was very aligned with that, took a significant position in credit default swaps, presumably as a hedge to protect some of his real estate investments and kind of as a super cat, almost layer of protection to his property exposures. And as a result, when that market incurred volatility, his portfolio significantly outperformed the industry. At about the same time, both myself and a friend saw an exposure to Berkshire Hathaway across a variety of dimensions. So it was a financial cross accumulations play. And at the time, the Berkshire credit default swap, I think, was trading for 10 basis points or less. Independently, we each kind of wrote this up. Management kind of decided not to do it for the obvious fact that, Berkshire wasn't going to default. But nevertheless, it had exposed itself to the volatility of the markets. And that volatility will show up in pricing eventually, especially in a long-dated or 5-year derivative. And sure enough, when the market incurred volatility, that 10 basis point swap increased in price to 500 basis points. That's 500 basis points. And more recently, prior to the first quarter of 2020, we were talking to clients that had an equity exposure on the left-hand side of the balance sheet, along with a decent D&O book, and we were recommending a particular long-dated derivative that, again, from a pricing perspective, was pretty cheap. Some carriers took advantage of it, others didn't. But when volatility exploded, needless to say, the value of that position was, swelled significantly. So kind of understanding your cross accumulations exposure and then having the ability to evaluate external pricing across those different exposures can lead to significant strategic opportunity. And certainly an AI-enabled platform can greatly facilitate that. I'd love to talk more on this topic, but I have to move on. So to the extent you all have any questions, I'm happy to pick those up in the Q&A session. But let's move on to inflation analysis. So inflation can mean many things to insurers, right? So like inflationary threats pertaining to claims, like replacement cost values for homes, medical costs, and reserves, are kind of generally well known and are at least tracked in many leading insurers. Now that tracking tends to be heavily manual, but nevertheless it does occur. Less well known are exposure-based impacts, how those impacts interact with the underwriting cycle, and how exposure-based growth strategies relate to distribution, seeded re, operational, and investment dynamics in kind of a dynamically inflationary environment. That's important because as inflation's occurring, a lot of those things are going to kind of increase in value, and there could be potential opportunities there. But if or when it tips, the risks are going to be significant, especially in a heavily leveraged economy, right? So very simple example, if you don't have any leverage on your balance sheet and you take a 1% hit to equity, your earnings may look nasty for a quarter or two, but it's not going to really impact your ability to remain a going concern. If you're leveraged 100 to 1 and you take a 1% hit to equity, kind of the game's over, right? That's always kind of important in general, but in an inflationary environment, it's significantly important. And there is no one way to attack it. So one way we suggest that firms do attack it, again, heavy kind of research to get a baseline understanding of what's happened in the past. The past is only so useful though, because the last time we faced this in the 60s, 70s, and early 80s, the US was an industrial economy. Today it's a financial economy, right? So there's whole difference, but nevertheless, start with history, move on to proofs of concept, and not just one, kind of a variety of them, and then discern ways to operationalize the insights. This industry has not been particularly good in general, right, about operationalizing analytical insights in the underwriting and claim sphere. Again, there are some carriers that do it exceptionally well, many do not. That capability is going to have to be widely developed as we kind of move forward. And here's an example why. So one of the things I get asked quite frequently is, okay, we kind of get what you're saying and what you're doing, but kind of who's done this in the past and like what does it look like? So I'm taking a kind of well-known example from the hedge fund industry, specifically Renaissance Technologies, which is a well-known quant fund that's compounded over 60% since the late 80s, literally. That is not a gamed number. And I normally don't read a quote on slides, but this is an important one, and I would like to read it in its entirety here. So the beauty of the approach that Ren uses was that by combining all their trading signals and portfolio requirements into a single monolithic model, Renaissance could easily test and add new signals instantly knowing if the gains from a potential new strategy were likely to top its costs. They also made their system adaptive, or capable of learning and adjusting on its own. If the model's recommended trades weren't executed for whatever reason, it self-corrected, automatically searching for buy or sell orders to nudge the portfolio back where it needed to be, a way of solving the issue that had hamstrung a prior model of theirs. The system repeated on a loop several times an hour, conducting an optimization process that weighed thousands of potential trade-offs or trades before issuing electronic trade instructions. Rivals didn't have self-improving models. Renaissance now had a secret weapon, one that would prove crucial to the fund's future success, close quotes. Now, consider that quote in the context of what we talked about earlier, and then know that many carriers kind of lean on some of their capital modeling capability to talk about cross accumulations. Those that do only really run those models once or twice a year. So consider once or twice a year to many times a day, and also consider the tight kind of infrastructure that Ren created to enable their model to consistently learn. There aren't really any carriers right now that have this capability. 10 years from now, I think there's going to be. Question is your carrier going to be one of those? Let me stop there. Thank you for your time, and turn it back over to our hosts.
Thank you very much, Joe. And just while we're changing speakers, I just want to say that you can share your questions over the Q&A chat, and we'll answer as many of them as we can after Boriana's section, or we'll follow up directly with you after the webinar. Thanks a lot, and over to you, Boriana.
1 sec. Perfect. Thank you so much. Just 1 second, sorry. Some technical difficulties here too. All right, you can see my screen? We're all good? Great. So thank you so much, Joe. As Fred and Joe pointed out, nimbleness is critical in responding to macroeconomic shifts at every touch point of the cycle. We will deep dive in one area that is particularly sensitive to these shifts, insurance pricing. And we will take a look at how insurance can use technology to set up pricing processes that are more nimble, which allows them to respond more quickly to changes while dealing with high degrees of uncertainty. So, as a shift in customer behaviors, especially as drastic as the one triggered by COVID-19, requires the ability to both respond quickly and responsibly. On the one hand, consumers expect that insurance carriers are going to be more responsive and more empathetic to their needs. Insurers that don't adapt quickly can lose out. For instance, according to a J.D. Power 2021 U.S. insurance shopping study, about 46% of auto insurance customers made changes to their insurance coverage last year. And most of them did so by going towards the top 10 insurance carriers. At the same time, carriers have a financial responsibility to ensure safe processes that lead to non-discriminatory prices and financially sound decisions. It's really the ability to move both with speed and robustness that differentiates the most nimble and successful insurers. Now, the good news is that technology can enable all insurers to strengthen both sides of the equation and democratize the playing field. Some technologies have been available for many years and have been adopted as norms over time. I was talking with Fred, and he jokingly mentioned that data-driven pricing has been around for 30 years. However, it's taken a long time for insurers to fully take advantage of all these processes and really create norms internally around that. Another example is the move to cloud. It's become a priority over the last decade, for instance, and it really allows to move with insurers to move with greater flexibility and to be able to scale. And that's particularly important when dealing with massive amounts of data, which is the case nowadays, but also ensuring greater collaboration. And that was particularly tested during the move to work from home. So insurance carriers that particularly, I believe someone is raising their hand, Alba Bazara. We're gonna get back to you shortly afterwards if you don't mind. So ensuring greater collaboration. So insurers that particularly only relied on on-premises infrastructure needed to adapt really quickly to move some of their services to the cloud in order to be able to respond to these changes. So now this became even a greater priority than before. Then we're also seeing that dynamically updated data sources, such as telematics, are slowly becoming more mainstream over time. And last but not least, and Frank pointed it out as well, a more flexible infrastructure, for instance, policy admin systems, are critical in deploying rates more efficiently. So all of these elements contribute to reducing cycle when it comes to pricing. However, the adoption of certain technologies such as machine learning and AI have been lagging when it comes to pricing. And why is that? Well, it's because they can entail significant risks that can undermine the robustness of the approach. For instance, some machine learning techniques can have a black box effect, meaning that a user may not be able to trace back the decision or explain them to others, and that can lead to all sorts of complications, including risks of adverse selection. This is why in a lot of cases, these type of techniques are used internally for research, but they're often not put into production. Now, today, there is compelling reasons to take advantage of these additional technologies that can really help insurers accelerate and automate processes internally, but it has to be done in a safe and transparent way. So we'll take a look at what that means when we're thinking in the concept of rate modeling. So when it comes to rate modeling, it is important to distinguish two elements. One is the construction and the modeling process, which can be either automated or manual. The other side is the model type or the result of the output, which can be either black box or transparent. And for a long time, there were manual solutions with a transparent output and automated processes with a black box output. Now, a new approach spearheaded by Akur8 allows the ability to automate while ensuring a transparent table-based output. What we're doing is applying machine learning to automate the production of models that you can understand, you can review, and you can interact with. For the actuaries in the Zoom, what we're doing is we're automating GAMs and GLMs. Why? Because by definition, they lend themselves to an output that is understandable and interpretable by humans. And it is really this combination of automation and transparency that is the answer to setting up a pricing framework that is both fast and robust. And what does this mean for insurers that they're able to take advantage of this capability? Well, it means speed. It means that there's a strong reduction in modeling time and accelerated iteration cycles, especially when you're updating your rating plans on a more frequent basis. Performance. It means more accurate outputs and a higher segmentation power. It means safer and more transparent processes, in particular, better governance throughout the whole rate-making process, and better internal communication, both within the teams and across teams, which is really key. And so all of these benefits that the insurers can see can also help translate to better ways of meeting customer needs, meaning that you're able to provide more personalized prices, more tailored products, and also build trust because you're able to provide more accurate prices and higher levels of transparency. So to wrap this up, I'd like to leave you with a story from one of our customers, Generali France. A lockdown period was instituted in France in the spring of 2020. This was the impact on the personal auto fatalities during that time. While the impact was drastic across the board, you can clearly see that there was variance across age and gender. And no one knew how long the lockdown would last and what would be the return back to normal. And at the time, we were working with Generali France as they were figuring out how to best respond to these massive changes in the summer of 2020 and temporarily make changes to their rate plan. Speed was really necessary to respond to this temporary shift, but also taking into account the robust processes that the team had to take into account. So what they did is that they used Akur8 in order to update their entire rating plan, and it only took them 2 weeks to do so. That was a 5x speed increase compared to what it would have caused them to do otherwise by using other types of solutions. And that allowed them to really quickly respond to this temporary shift, update rate plans, deploy them, and then quickly monitor and see if there's going to be any needed adjustments over time. When you fast forward to this summer, they're basically using Akur8 again in order to do a model refresh. And so this is just one illustration of the power of more nimble processes in the face of drastic temporary shifts and high degrees of uncertainty. So I'm going to leave it back to Anne-Laure and see if you have any questions for us. Thank you so much for your time.
Thanks, Boriana. Thanks, everyone who's attending this webinar. I hope you enjoyed it. Just so you know, we'll be sending the recording of the webinar as a follow-up with the link, as well as our contact details if you want to reach out directly. I mean, we have a few minutes left, so we can open up for questions. Some of you shared some questions via the chat. So I think we have time for at least one of them. Fred, the first question is for you, and it is as follows. So what do you foresee being the biggest challenges for established insurance carriers that are playing catch up to digitally native insurtechs, who by design are more nimble?
Well, I think probably the biggest challenge for large insurers is on the side of being able to implement quickly and effectively, and because they have so much at stake in their existing books of business, being able to manage the effects on their existing customers. New startups, new entrants don't have a lot of existing customers. They can worry less about the effects. The advantage that large carriers have is they already generate huge amounts of information from their interactions with their existing customers. And some of that's in the loss and premium side and the value of having more data. But just think about the level of claims contacts, the level of customer service contacts that an extremely large carrier has. That creates an enormous amount of data that they can analyze and really understand how their customers are reacting to different things. They can build much more elaborate models than the sort of new insurtechs can.
Thanks a lot, Fred, for these clarifications. We have a few minutes left, so I think maybe we can have one more question. This one's maybe for you, Boriana. What do you mean by transparent when you refer to transparency in pricing?
Yeah, sure thing. Happy to answer. So when we talk about transparent processes, we really mean processes that you can understand, explain, and interact with. So the last piece is especially key, the ability to interact with. So making changes and applying changes based on actuarial knowledge or business constraint or regulatory constraints. So it's really the interactability part of that. And another element I would add is think of it as being able to break down the pricing into a formula and explain each component to your counterparts so that they can explain each component that went into it as well. Thank you.
Thanks. And Joe, I think we have time for a quick one for you as well. So do you think an insurer can ever develop capabilities that are similar to REN technologies?
So, so first of all, there is a difference, right, an obvious difference between a trading firm and an insurer. So in that context, they certainly can develop REN-like capabilities into the space. And I think there's a number out there who are already going down that path. So I think Fred mentioned some of the new entrants. I've seen quite a few of those deals and worked on a number of them. And every one I've worked on, it kind of starts with, hey, we have a fresh data environment. We're going to architect it and create it correctly. And we're going to continue developing it across the cycle that will enable us to continue to outperform once the market tops off and even gets soft. I mean, I've been doing this a long time, like Fred, and you know, when senior people hear this, we kind of chuckle and say, wow, you know, they're going to do that until the market gets soft, and then they're going to do deals, do book rolls and the like, and before they know it, they're going to kind of find themselves. And for the most part, many of them will, but there's a lot of new startups, and a couple of them may have the right founders who aren't looking for a buyout in 3 to 7 years, and who legitimately see an opportunity and want to kind of build the capability. Those firms are probably out there, and to the extent they are, and they're able to kind of look at this on a program by program basis, realizing it's not a silver bullet, it's more of a program, and the more work they put into it, the more value they get out. Again, within 10 years, we'll probably see who the winners are. They'll have emerged, and I'd be very shocked if AI wasn't at the center of it, across not just pricing, but pricing, claims, reserving, and more importantly, risk management across the firm.
Thank you very much, Joe. I think that's all the questions we have time for today. So thank you so much to all the participants for attending this webinar and for all of your questions. Thanks a lot to our 3 speakers, Fred, Joe, and Boriana. If you have any further questions on the webinar, feel free to reach out to Boriana, Fred, Joe, or myself directly. We'll share the contact information in the follow-up email along with the link with the recording of the webinar. And thank you so much, everybody, and enjoy the rest of your day.